Welcome to Tax Strategy and 1031 Exchanges, Course 20 in the MaxLife Commercial Academy. I'm Ryan Solberg, real estate broker with MaxLife Realty LLC, license number 3354351. This course is about one of the most powerful wealth building advantages available to commercial real estate investors, the tax code. The strategies we cover in the next 38 minutes are completely legal, used by the wealthiest investors in the country, and available to you right now, whether you are a first-time buyer or a seasoned portfolio holder. Understanding depreciation, 1031 exchanges, and passive activity rules can dramatically change your after-tax returns. Let's get into it. Commercial real estate has four structural tax advantages that no other common asset class can match simultaneously. First, depreciation. The IRS assumes a commercial building wears out over 39 years, or 27 and a half for residential, and lets you deduct that wear and tear as an expense each year, even if your property is going up in value. On $1 million building with a $200,000 land value, you're writing off about $20,500 per year in non-cash expense. That offsets real rental income. Second, capital gains deferral through the 1031 exchange. When you sell, instead of writing a check to the IRS, you roll your proceeds into a new property and defer the tax. Some investors chain these exchanges for decades, building enormous portfolios without ever paying capital gains during their lifetime. Third, passive loss rules. Real estate losses, especially from depreciation, can offset passive income from other investments. And for those who qualify as real estate professionals, those losses can offset ordinary W-2 income as well. Fourth, the step up in basis at death. This is the ultimate exit. If you never sell and pass the property to your heirs, the basis resets to current market value. Every deferred gain, every recaptured depreciation, gone. These four advantages stack. An investor who understands all four and plans around them operates in a completely different financial universe than one who ignores them. Let's talk about the three depreciation tools that sophisticated investors use together. Standard depreciation is the baseline. Commercial property depreciates over 39 years, meaning you deduct 1/39th of the building's value each year. It's reliable but slow. Cost segregation changes the game. A licensed engineer examines your property and reclassifies components: carpet, lighting, specialty electrical, parking lots, landscaping, from the 39-year bucket into shorter 5-on, 7-7, or 15-year buckets. Those assets depreciate much faster, front-loading your deductions. A cost segregation study on a $2 million building might identify $400,000 worth of components that now depreciate over 5 to 15 years instead of 39, then add bonus depreciation. Through 2022, bonus depreciation was 100%. In 2023, it dropped to 80%. In 2024, it's 60%, and it continues declining 20 percentage points per year until it phases out entirely under current law. But even at 60%, if your cost segregation study identifies 400,000 in short life assets, you can deduct 240,000 in year one from bonus depreciation alone. Section 179 is a related but separate provision that lets you immediately expense qualifying business property up to a dollar limit, currently around 1.16 million for 2024. The real power is stacking all three. On the right acquisition, you can generate a paper loss in year one that exceeds your actual cash investment. The IRS built these incentives to encourage real estate development. Use them. The 1031 like-kind exchange is the single most powerful tax deferral tool in commercial real estate. Section 1031 of the Internal Revenue Code says that if you exchange one investment property for another like-kind property and follow the rules precisely, you defer all capital gains tax and depreciation recapture. Here are the rules you must know cold. First, both properties must be held for investment or productive use in a trade or business. Your primary residence does not qualify. A vacation home you use personally typically does not qualify. Second, you must use a qualified intermediary, a QI, to hold your proceeds between the sale and the purchase. The moment the money touches your bank account, the exchange is blown and the full tax bill comes due. Hire a reputable QI before you close. Third, you have 45 days from the closing of your relinquished property to formally identify potential replacement properties in writing to your QI. This deadline is firm. No extensions except for federally declared disasters. Fourth, you must close on your replacement property within 180 days of closing the sale. Again, firm deadline. Fifth, to defer all gain, you must trade equal or up. The replacement property must be of equal or greater value, and you must reinvest all net equity. Any leftover cash, called boot, is taxable. These are the core rules. There are advanced structures we will cover next, but master these first. At MaxLife Commercial, we work with clients on 1031 planning regularly. Call us at 321-586-2121 if you are mapping an exchange. Once you master the basics of a 1031 exchange, a whole world of advanced structures opens up. The Delaware Statutory Trust, or DST, is one of the most popular solutions for investors who want to complete an exchange but do not want the headache of managing another property. A DST is a fractional interest in a large institutional property. Think a 200-unit apartment complex or a Class A industrial park, owned by multiple investors through a trust. The IRS confirmed in Revenue Ruling 2004-86 that DST interests qualify as like-kind replacement property. You can exchange into a DST in days, meet your 45-day deadline easily, and become a truly passive investor. The 721 UPREIT exchange is a step beyond the DST. Instead of selling to the market, you contribute your property directly to a real estate investment trust's operating partnership in exchange for operating partnership units. You defer tax, become a partial owner of a diversified REIT portfolio, and gain liquidity. Eventually, you can redeem OP units for REIT shares and sell on the open market. Many large REITs actively seek this. The installment sale under Section 453 is not a 1031, but is a complementary strategy. Instead of receiving all proceeds at closing, the buyer pays you over time. You only recognize gain as you receive payments, spreading your tax bill over years. It works especially well for sellers who do not find a suitable 1031 replacement. Opportunity zones, reverse exchanges, and improvement exchanges round out the toolkit. The right structure depends on your timeline, your replacement options, and your income situation. Always work with a tax advisor on these. The passive activity rules governed by Section 469 of the Tax Code are the gatekeeper between your real estate losses and your other income. Here is how they work. The IRS presumes that rental real estate is a passive activity. That means losses generated primarily from depreciation can only be used to offset passive income. If you do not have enough passive income, those losses get suspended and carried forward to future years. There is one exception for smaller investors, the $25,000 rental loss allowance. If your adjusted gross income is under $100,000, you can deduct up to $25,000 of rental losses against ordinary income. That allowance phases out completely at $150,000 of AGI. For higher earners, the real estate professional designation is the unlock. To qualify, you must meet two tests. One, you spend at least 750 hours per year in real property trades or businesses in which you materially participate. Two, more than half of all your personal services for the year are in real property activities. If your spouse qualifies and you file jointly, you can use their status. Once you have reps, all of your rental losses, including massive cost segregation losses, can offset your W-2, business income, and any other ordinary income. A physician who acquires an apartment complex and whose spouse is a full-time property manager can potentially wipe out six figures of W-2 income with real estate losses. Document your hours carefully. The IRS scrutinizes reps' claims. Keep a contemporaneous log. Tax strategy is not something you do once a year in April. It is a year-round discipline built into every deal decision. Let's talk about four planning levers you should be pulling actively. Entity structure matters from day one. Most commercial investors hold property in LLCs, which are pass-through entities by default. That means depreciation losses, gain, and income all flow directly to your personal return. That is usually optimal. But if you are running a real estate business, property management, development, the entity structure gets more nuanced. Talk to a CPA who specializes in real estate before you set anything up. Timing your acquisition strategically can generate meaningful tax savings. If you close on a property in December, the IRS allows you to claim a full month of depreciation for that year. More importantly, a cost segregation study done on a Q4 acquisition lets you front load those accelerated deductions into the current tax year. If you are looking at a purchase and you know it will generate large paper losses, closing before December 31 versus January 2 can be worth tens of thousands of dollars in 1 year. Grouping elections under the passive activity rules allow you to treat multiple rental properties as a single activity. This can make it much easier to demonstrate material participation across your portfolio without having to track hours, property by property. Finally, self-directed retirement accounts, particularly solo 401ks for self-employed investors, allow you to invest retirement dollars directly into commercial real estate. Inside a Roth structure, appreciation and income grow completely tax-free. Leverage inside these accounts triggers unrelated business income tax, so model that carefully. Everything we have covered in this course: depreciation, cost segregation, bonus depreciation, 1031 exchanges, passive activity rules, real estate professional status, entity structure, all of it comes together into one integrated approach, the tax-aware CRE career. This is not about being aggressive or finding loopholes. Every strategy we discussed is explicitly written into the tax code. These are incentives the government put in place to encourage real estate investment. Your job is to know them and use them. Start by assembling the right team. A CPA who specializes in real estate investors is non-negotiable. A general CPA will miss strategies that a specialist catches automatically, a qualified intermediary you trust before you ever list a property for sale, a cost segregation engineer for every major acquisition, and ideally a tax attorney for complex structures like UPREITs or opportunity zone funds. Before every deal, run a full after-tax model. What does this property look like with standard depreciation, with cost segregation and bonus depreciation? How does your passive income situation change? These numbers should be in your underwriting, not an afterthought. Plan your exit from the beginning. The most expensive tax mistakes I see happen when investors sell without a plan and realize too late that a 1031 would have saved them hundreds of thousands of dollars. At MaxLife Commercial, we walk our clients through these decisions at every stage. If you want to talk through a specific deal, a 1031 exchange, or your overall portfolio tax strategy, reach out to us. I'm Ryan Solberg, license number 3354351, and you can reach us at 321-586-2121 or visit maxlifedevelopment.com/academy. This has been Course 20 Tax Strategy and 1031 Exchanges. Congratulations! You have completed Course 20 and the full MaxLife Commercial Academy curriculum. That is a serious accomplishment. You now understand the tax advantages that make commercial real estate the preferred wealth building vehicle of the ultra high net worth. You know how to execute a 1031 exchange, how to commission a cost segregation study, how to qualify as a real estate professional, and how to plan every exit before you ever list a property. These are skills that will compound in value for your entire investing career. If you want to put this knowledge to work on a real deal, my team at Max Life Realty LLC is ready to help. I'm Ryan Solberg, real estate broker, license number 3354351. Call us at 321-586-2121 or visit maxlifedevelopment.com/academy to explore our full course library and connect with our brokerage. Thank you for learning with us. Now go build something.